Little things, little tidbits that you need to take a look at in regards to your resolutions for a better retirement life or just better financial life. One of them is rebalancing your portfolio. So when you take a look at rebalancing, the market has done very well lately, and so a lot of you might be heavily weighted in stocks versus bonds, depending on, of course, what your allocation was. So let me draw this out real quickly for you, is that let's say you see this pie chart, and most people are familiar with what a pie chart is, and you might have 50% of your allocation in stocks, and then you might have 50% of your allocation in bonds. Maybe this was the allocation in 2009. Well, the S&P 500 has done almost 200%, over 200% since that time frame. So guess what happened to your portfolio? Is that now you don't have 50% of the portfolio, right? It has shifted. It might be now, right, 30% in bonds and now 70% in stocks. So what do? Now you're heavily weighted in stocks. It feels good because you're getting a high rate of return, but guess what? You're also taking too much risk. So you want to make sure that you control the risk parameter of that overall portfolio. So anytime these things get out of whack, you want to sell the stocks to get you back to 50%. Because guess what? Stocks go up and also stocks go down. So you want to make sure that you can control the risk, and rebalancing is a simple thing that you can do to make sure that you can control that risk. Al?
Another thing, Joe, is reducing fees, and a lot of investments come with high fees. And a lot of people don't really know that there are fees, and here's three different costs that you may or may not know about. One is the initial load. There are some loaded mutual funds where you actually have to pay to get into them. Many are no load. No load, of course, is better because you're not paying anything. But even more importantly is the annual fund fees. A lot of these mutual funds have very high internal fees. Morningstar says the average is about 1.3%. Now, some index funds are closer to 0.2, 0.3%, so they're much lower. And then also you got to look at turnover. Turnover is the fund manager buying and selling stocks inside the portfolio. And when that is done, it's costing you a lot of money. In fact, 100% turnover equates to about a 1% charge on your portfolio. So in other words, if you otherwise would have received 10% rate of return, you're receiving 9%. So be aware of these fees because there are certain investments that have lower fees.